Welcome to our deep dive into Luxembourg Intra-Group financing. We're looking at things as they stand in May 2025.
Yes, it's a really key area. Luxembourg is, such a hub for cross-border finance.
Exactly. And today we're unpacking the essentials, how SOPARFIs and investment funds operate when they're financing related companies.
That's right. The mission really is clarity. We want to give you a clear picture of the current regulatory and tax landscape.
And we're drawing on solid ground here: research, Luxembourg legal texts, EU directives, expert analysis, the works.
Indeed. So maybe to set the stage, let's define what we actually mean by intragroup financing here in Luxembourg.
Good idea.
PwC Luxembourg, for instance, they talk about it as a Lux entity giving loans or cash advances to its related companies.
Okay.
But the key part is where that Lux entity itself gets the money. It's funded through financial means, like loans from banks or maybe other group companies.
Right, so it's not just passing on its own equity. It's often a back-to-back kind of arrangement.
Precisely. And that immediately brings Luxembourg's transfer pricing rules into sharp focus. You have to look at the whole chain, the inbound funding and the outbound financing.
Makes sense. So what's the absolute core principle driving this?
Well, it's all about arm's length remuneration that's driven by Lux rules, but also international standards like the OECD guidelines.
Okay.
The Luxembourg financing entity, it has to be compensated fairly at arm's length for the functions it actually performs, the assets it uses, and importantly, the risks it genuinely takes on.
So just calling yourself a financing company isn't enough?
Not at all. The OECD's 2020 report on financial transactions really hammers this home. You need to look at the commercial rationale, the substance behind it. Does it mirror what independent companies would actually do?
Got it. So a real business purpose, justifiable terms, especially the interest rate, like it was between unrelated parties.
Exactly. Which brings us neatly to the bedrock, the arm's length principle itself.
Article 56 abuse of the income tax law, right?
That's the one. It mandates that transactions between associated companies have to be on terms comparable to the open market.
And the tax authorities have given guidance on this.
Oh, yes. Quite detailed guidance. The circular LIR number 56156 EPS 1 from back in 2016, it follows the OECD guidelines very closely.
Yeah.
You absolutely need to stick to this to avoid issues.
So what does that circular actually say? How do you apply this in practice?
Okay, first off, it stresses accurate delineation. You can't just look at the contracts. You need to understand the true commercial and financial relationships. What are the parties actually doing? Conduct over form.
Right, and then comparing it to the market.
Yes. Comparability analysis is essential. You need to compare your intragroup deal with similar independent transactions.
That sounds tricky. Finding truly comparable deals must be tough sometimes.
It definitely can be, which is why the circular also puts huge emphasis on a thorough functional analysis, the FAR analysis.
Functions, assets, risks.
Exactly. You have to clearly map out what does the Lux entity do? Loan origination, credit risk assessment, monitoring, whatever it is. What assets does it use? And crucially, what risks does it really take on? The pay needs to match that profile.
And risk isn't just about signing a paper, is it? It's about actual capacity.
Precisely. The circular talks about both the capacity to manage risk, having the skills, the people, the processes, and the capacity to assume risk.
The financial muscle.
Right. Does it actually have the financial buffer to handle losses if things go wrong? And tied to that is capital adequacy. Does it have enough capital for the risks it's taking? Risk consumption without capacity just isn't credible.
So if you tick all those boxes, how do you set the price?
Well, the remuneration itself must be arm's length, using OECD-approved methods. The circular does mention some, let's call them simplified approaches.
The 2% return on assets or 10% on equity things.
Yes, but be careful. They are not safe harbors. They're administrative practices, and only if certain conditions are met: substance, risk. The authorities expect proper, tailored TP docs. Don't just slap on the 2%.
Okay, good warning. So the clear message is Luxembourg demands substance, real activity, market pricing, and the financial clout to back it up. Paper shuffling won't cut it.
Especially not now. With things like potential ATAD 3 on the horizon, the focus on genuine economic substance is only going to get stronger.
Right. Let's move on to the SOPARFI then. Often seen as just a holding company, but it can do more, can't it?
Absolutely. A SOPARFI Société de Participation Financière is a fully taxable standard Luxembourg commercial company, usually an SA or an SARL.
So not regulated like a fund.
Correct. Non-regulated.
Yeah.
And its corporate purpose, its object can be really broad: Holding shares, yes, but also active financing, holding real estate, managing IP.
Makes them versatile?
Very. They're a cornerstone of Lux corporate structuring, and they can definitely function as active financing vehicles.
Are there specific corporate advantages?
Well, for an SA, you can use nominee shareholders, which offers some confidentiality. And there are potential deductions related to capital gains tax sometimes. The basic rules come from the old but updated 1915 law on commercial companies.
So minimum capital requirements, registered office, the standard stuff.
Exactly. EUR 31,000 for an SA, though only 25% needs to be paid up initially. EUR 12,500 for an SAL, fully paid up. You need a registered office in Lux, directors, shareholders, all the normal corporate governance.
You mentioned they can be mixed holding and financing. How does that work in practice? Sounds efficient, but maybe complex tax-wise.
It is efficient, but yes, requires careful handling. You absolutely have to distinguish the profits from financing, which are taxable from any income, from qualifying shareholdings, which might be exempt under the participation exemption.
So sharp accounting and clear TP policies are key.
Crucial. You've got the traditional SOPARFI benefits, like the participation exemption on dividends and gains coming in, but you have to balance that with the operational demands of actually running a financing business.
Yeah. Which brings us back to substance.
Always. Skilled people, documented decisions for the financing side, enough capital. It's paramount, especially with global trends like ATAD III may be coming. A SOPARFI financing hub cannot be a letterbox. It needs real economic functions.
Okay, so how are these SOPARFIs taxed when they are doing financing? It's this mix you mentioned.
Right. They're fully subject to corporate income tax, CIT, and municipal business tax, MBT. That's about, 24.94% combined in Luxembourg City for 2024?
And net wealth tax.
Yes, they pay annual NWT too, though you can reduce or eliminate that if you have qualifying participations or use an NWT reserve. But there's a minimum NWT regardless.
But the big one is the participation exemption, right? Article 166 LIR.
That's a major feature. It exempts dividends and capital gains from qualifying shares, provided you meet the conditions holding percentage or acquisition cost holding period, and the subsidiary needs to be subject to a comparable tax.
What about money flowing out? Withholding taxes?
Generally, dividends paid by the SOPARFI get hit with 15% WHD, but that can be reduced by treaties or the EU parent subsidiary directive.
And interest payments, that's key for financing.
Exactly. And generally, there's no WHD on arm's length interest paid out to non-residents. Or on liquidation proceeds, that's a big plus. Though anti-abuse rules can always kick in.
And of course, the arm's length principle applies to everything.
Everything. Article 56 bis. Plus, you have the ATAD rules impacting things now.
Yes, the interest limitation rules from ATAD 1, Article 168 bits.
Correct. That limits how much exceeding borrowing costs you can deduct. Broadly, net interest expense above the higher of 30% of your fiscal EBITDA, or EUR 3 million, isn't deductible.
That must bite for debt-heavy financing SOPARFIs.
It certainly can. And don't forget minimum NWT if they hold a lot of financial assets. And VAT pure holding is usually out, but providing financing services for a fee might trigger VAT.
So tax efficiency is a real balancing act, taxable financing income versus potentially exempt holding income.
It requires very careful structuring, robust TP docs for the financing side, and making sure you meet the participation exemption rules. And those interest limitation rules directly hit your ability to deduct interest expense.
And as you said, the international rules, ATAD 1, 2, D6, maybe ATAD 3, they're all squeezing structures that rely purely on exemptions without real substance.
Precisely. The game has changed. You need demonstrable economic activity to justify mobile income-like interest. TP, interest limits, anti-hybrid rules. They all interact and can really change the tax outcome.
Given all that, how are SOPARFIs actually used for intragroup financing? What structures do you see?
Several common ones. The classic intermediary financing company borrows it on lens, and it earns an arm's length spread for its functions and risks.
Okay.
Or a group treasury center. This is more involved cash pooling, risk management for currency or interest rates, centralizing finance. But that really demands significant operational substance.
Right. People and processes on the ground.
Definitely. And then you see combined holding and financing vehicles. They hold shares in subs and provide debt finance. Requires integrated management, clear separation of activities for tax.
What makes Luxembourg's SOPARFIs attractive for these roles, despite the complexities?
Well, several long-standing advantages remain. The huge double tax treaty network is a big one. Helps cut withholding taxes elsewhere.
The participation exemption we discussed?
Yes, for qualifying holdings. And, critically, the general absence of WHT on outbound interest, provided it's arm's length and not abusive.
Plus, being in the EU helps.
Access to EU directives, yes. And Luxembourg itself offers a very stable legal, political, economic environment. There's a deep pool of financial services expertise, responsive regulators, and flexible company law with the SA and SARL options.
But the theme continues. Efficiency now depends on substance and compliance, not just treaties and exemptions.
Absolutely. BEPS and ATAD have shifted the focus squarely onto real economic functions and genuine risk-taking. SOPARFIs used for financing need rock-solid TP documentation, justifying everything: the interest rates, the commercial rationale, the debt capacity, their role in the group's value chain.
The OECD guidance on financial transactions, the Lux Circular, they demand detailed justification.
They do. The era of just having a nameplate and a bank account is closing fast. Substance and documentation are critical.
Okay, let's pivot to investment funds. Luxembourg is enormous in the fund space. How do they fit into intragroup financing?
It's a huge sector. Europe's largest fund domicile, second globally, a very sophisticated ecosystem supervised by the CSSF.
And it's not just UCITs for retail investors.
Not at all. You have UCITs, yes, but also a vast range of alternative investment funds, AIFs, for professional or well-informed investors. Think SIFs, SICARs, and very popular RAIFs.
And these funds can be part of group structures.
Often they are. They can be involved in intragroup financing in different ways, maybe as lenders, sometimes as borrowers, or even as conduits.
The regulatory framework must be pretty dense.
It is. You've got the 2010 UCI law for UCITs, the 2013 AIFM law implementing the EU's AIFMD, specific laws for SIFs, SICARs, RAIFs.
And these impose significant requirements.
Yes, big focus on risk management, conflicts of interest, valuation, investment strategies, generally more rigorous than for a standard company like a SOPARFI, because you're dealing with collective investments and investor protection.
Can a fund just lend money directly to its managers group?
That's tricky. Very tricky. Conflict of interest rules are a major hurdle there. The dynamic is different if the fund is receiving funding, like seed capital, or maybe investing in debt instruments issued by a related party.
AIFs have more flexibility here than UCITs.
Generally, yes. AIFs often have broader investment mandates. They can receive financing, like shareholder loans, or invest in group debt. If it fits their policy, it's arm's length, and conflicts are managed meticulously.
And the new AIFMD II rules on loan origination will impact this too.
Definitely. That's a key development for funds potentially acting as financing providers.
Let's look at UCITs first. Highly regulated retail focus.
Yeah.
Can they really do much intragroup financing?
Honestly, their direct role is very limited. UCIT's rules are strict focus on liquid, transferable securities, money market stuff.
Diversification rules, borrowing limits.
Exactly. Borrowing is usually capped at 10% of NAV and temporary. Direct loan origination, not really their game. And the conflict of interest rules are incredibly tight.
Management companies have to act in the best interest of the fund and its unitholders.
Always. So related party deals face intense scrutiny. UCITs are very unlikely to be direct intragroup lenders. It just doesn't fit the model liquidity needs conflict rules.
They might receive seed capital, or a group might invest in a UCITs.
Right. The UCITs is the recipient or the investment product, not the financing provider to the group. High regulation, retail focus, generally unsuitable for tailored intragroup loans.
Maybe investing in listed bonds of a group company.
Theoretically, maybe, within a huge financial group. But only if they're listed, liquid, meet all UCITs criteria, arm's length, and clearly in the unitholder's best interest. That's a very, very high bar.
Makes sense. So AIFs are where the action is more likely to be. More flexibility.
That's generally true. AIFs cater to professional, well-informed investors. Governed by AIFMD via the Luxembourg AIFM law, they can invest in a wider range of assets.
Which types are most relevant for financing? You mentioned SIFs, SICARs, AFs.
Yes. The SIF, Specialized Investment Fund, needs CSSF approval, targets well-informed investors, broad asset eligibility, but needs risk diversification, usually max 30% in one issuer, pays a low subscription tax, 0.01%, exempt from CIT and BT and WT. Can definitely be a debt fund.
Okay. And the SICAR?
SICAR, Investment Company and Risk Capital, also for well-informed investors, CSSF approved. Its focus must be risk capital, PE, VC, infrastructure, real estate type assets. It pays normal CIT and BT, but gets an exemption for qualifying risk capital income. No subscription tax. Potentially good for equity-like or mezzanine finance within a group.
And the RAIF seems very popular now.
The RAIF, Reserved Alternative Investment Fund, is, yes, also for well-informed investors, but crucially, not directly supervised by the CSSF. It must appoint an authorized AIFM who provides the oversight.
So faster to market.
Much faster. And very flexible, it can choose to mirror the SIF rules and tax regime or the SOCAR rules and tax regime.
But they all fall under the AIFMD framework.
Correct, which means requirements for the AIFM, like robust risk management, independent valuation, transparency to investors and regulators, and especially conflict of interest management. That's critical for any intra-group stuff.
And delegation is allowed, but controlled.
Strictly controlled. The AIFM stays responsible. No letterbox entities allowed.
So how can AIFs actually play in intra-group finance?
Well, as lenders, AIFMD II now provides a clear framework for loan origination by AIF's risk retention rules, diversification, leverage caps, policies needed. So a RAIF or SIF debt fund could lend to group entities.
But managing conflicts and ensuring arm's length terms would be vital.
Absolutely essential. They can also be borrowers within their fund rules and AIFMD leverage limits. They could borrow from the merit group, again, arm's length, conflicts managed.
Or invest in group debt.
Yes, they can invest in related party bonds or debt if it fits their strategy and risk profile and is arm's length.
And you said the RAIF is often preferred.
Its speed and flexibility make it very attractive. And AIFMDT's loan origination rules might boost RAIFs structured as debt funds even further, potentially for group financing under controlled conditions.
The biggest challenge seems to be managing conflicts, especially if there are third-party investors.
That's the crucial point. The AIFM has a fiduciary duty to the fund and all its investors. Any intra-group transaction needs robust governance, independent valuation maybe, transparent disclosure like CSSF's Circular May TG 698 demands to prove fairness to everyone.
Tell us more about that Circular 18698. How does it reinforce this?
It's key CSSF guidance from 2018 for investment fund managers, both UCITES, MANCOs, and AIFMs. It covers governance, internal controls, risk, compliance, audit, delegation, the whole operational setup.
And specifically on conflicts.
Very specifically. IFMs must have an effective conflicts policy. They need to identify potential and actual conflicts between the IFM and the fund, between funds, between the fund and other clients.
And have procedures to prevent or manage them.
Right. And if managing isn't enough to prevent harm to investors, they must disclose the conflict before doing business. The CSSF looks very closely at situations where the manager or a related party might gain financially at the fund's expense.
It also covers substance in Luxembourg.
Yes, it elaborates on needing adequate resources, senior management, key functions actually present and operating from Luxembourg.
Right.
Reinforces the no letterbox rule for delegation too. The IFM stays responsible.
So for any fund involved in intergroup finance, this circular demands a really robust internal framework.
Extremely robust. Documented processes for identifying, assessing, managing, monitoring conflicts. The IFM's board needs to clearly show how conflicts were handled fairly for all investors. Maybe use independent directors, get fairness opinions, use external benchmarks. The burden of proof is firmly on the IFM.
Okay, so whether it's SOPARFIs or funds, the tax side is complex. Let's dive deeper into transfer pricing, specifically for these intra-group loans.
Right. Article 56 bis LIR and the main TP Circular 561, 56 bis 1 are paramount. And the absolute core tenet is substance over form.
Economic reality trumps the paper contract.
Always. Just calling yourself a financing company means nothing if you don't actually perform the functions and manage the risks associated with financing.
Which requires that detailed functional analysis, FAR, you mentioned.
Indispensable. What exactly are you doing? Origination, credit checks, servicing, managing covenants, treasury functions. What assets are you using? Funding sources, software, expertise. What risks are you really bearing? Credit risk, market risk, interest rate, currency, operational risk.
And the entity controlling the key risks with the financial capacity should get the reward.
That's the principle. And when setting the interest rate or the spread, you need to look at comparability factors.
Right.
Loan amount, maturity, currency, the borrower's creditworthiness. You often need a rating-like assessment. Is there collateral? Guarantees? Seniority of the debt? What were the market conditions when the loan was made?
The OECD TP guidelines give pointers here too. Chapter X.
Yes, highly relevant in Luxembourg.
Yeah.
Guidance on delineation, creditworthiness, how to approach arm's length rates, considering guarantees, group synergies, cash pooling. It's all in there.
What about those simplified measures again, the 2% or 10% returns?
Again, not safe harbors. They are administrative practices for very specific situations, pure intermediary financing with low risk or regulated treasury functions, and only if the substance and risk conditions are met. The ACD, the tax authority, expects robust, bespoke TP documentation. Generic policies relying on these simplified rates can be easily challenged.
And for AIFs lending under AIFMD II, especially to related parties?
TP is critical there too. The AIFM has to show the terms are arm's length. That's for tax compliance, yes, but also crucial for protecting other investors in the fund and meeting the AIFMD conflict rules. They might need independent benchmarks to prove it.
Beyond TP, the ATAD directives have had a massive impact, haven't they? Interest limitation, GAR, hybrid rules.
Huge impact. The whole ATAD package reshaped things significantly. The interest limitation rule, Article 168 BP LIR from ATAD 1 is a big one.
The 30% of EBITDA or UR 3 million cap on deducting net borrowing costs.
That's the one. Borrowing costs is defined broadly, but importantly, financial undertakings are generally excluded.
Like banks, insurers, and regulated funds, AIFs, UCIs.
Typically, yes, when they borrow for their investment activities. Standalone entities might also be exempt. Unused capacity or non-deducted costs can be carried forward. But for a standard debt-funded SOPARFI, which usually isn't a financial undertaking for this rule, it can really limit interest deductions.
Then there's the GAR General Anti-Abuse Rule.
Paragraph 6 of the Tax Adaptation Law, aligned with ATAD 1. It lets authorities ignore non-genuine arrangements, those lacking valid commercial reasons reflecting economic reality, if the main aim was a tax advantage defeating the law's purpose.
So a backstop for artificial financing structures.
Exactly. Even if you follow the specific rules, if the whole thing lacks substance or commercial sense, GAAR can bite. And then you have the hybrid mismatch rules from ATAD 2, Article 168 or LIR.
Targeting deduction or inclusion outcomes or double deductions.
Right. If a payment from Luxembourg is improperly taxed elsewhere because of a hybrid element, different treatment of the instrument or entity. These rules can neutralize the tax benefit, often by denying the deduction in Luxembourg.
So ATAD really tightens the screws on aggressive planning.
Definitely. Interest limitation hits the tax shield of debt. GAAR and hybrid rules catch artificial structures. For CARFIs need to be very mindful. Interest substance and commercial rationale.
And that exemption from interest limitation for financial undertakings is a key difference between using, say, a regulated AIF versus a SOPARFI for borrowing.
It's a major structuring consideration. An AIF borrowing for investment might deduct its interest fully, subject to TP, while a SOPARFI's deduction could be capped. That affects the cost of funding.
What about withholding taxes? Always a hot topic.
Generally, Luxembourg's non-WHT on arm's length interest paid to non-residents is a big draw.
But dividends from SOPARFIs still face 15% WHT.
In principle, yes, though treaties or the EU parent subsidiary directive can reduce or eliminate it. Liquidation proceeds are usually WHT-free, and distributions from funds like SIFs, SICARs, RIs are typically exempt too.
But anti-abuse rules apply here too.
Always. Domestic or treaty rules can deny benefits if structures are artificial, lack substance, or are mainly for tax avoidance.
So no WHT on interest is good, but you need to see the whole picture.
Exactly. ATAD interest limits might restrict the deduction for the payer anyway, and you need to consider the recipient's tax treatment, CFC rules, hybrids. WHT is just one piece.
And if interest isn't arm's length, too high.
Authorities can recharacterize the excess portion as a hidden profit distribution, and then dividend WHT applies. Just reinforces why robust TP documentation for interest is so critical.
And finally, on the tax front, DSC 6 mandatory disclosure. How does that play in?
DSC 6 means automatic exchange of info on potentially aggressive cross-border tax planning arrangements.
Here.
Intermediaries, or sometimes the taxpayer, have to report arrangements hitting certain hallmarks.
And some hallmarks relate directly to financing.
Yes. Hallmark C1 looks at deductible payments to associated enterprises where the recipient is in a zero-low tax jurisdiction or gets a full exemption or benefits from a preferential regime.
So typical financing into certain holding structures could be reportable.
Very possibly. Also, Hallmark E3 on transfer pricing. If you transfer functions, risks, assets cross-border within a group and the transfer's projected profit drops significantly, that can be reportable.
So DSC 6 increases transparency dramatically.
Massively. Automatic exchange across the EU. Reporting doesn't automatically mean it's abusive, but it flags it for review. Puts more pressure on having robust, commercially justified, fully compliant structures, especially on the TP and ATAD side.
It's an early warning system for tax authorities.
Pretty much. And a significant compliance burden for businesses with lots of intra-group financing. You need processes to identify, assess, and report these things. Tax governance is key.
Okay, let's shift to the very latest pulse. Updates as of early May 2025. AIFMD II is a big one. Where does Luxembourg stand?
Right. AIFMD II is in force at EU level since April 2024. Member states, including Luxembourg, have until April 16, 2026 to transpose it into national law. Rules mostly apply from them.
What are the key changes impacting financing?
A major one is the formal framework for loan origination by AIFs, rules on policies, risk assessment, but also specifics like risk retention, generally 5% for sold loans, leverage limits 175% NAV for open-ended, 300% commitment for closed-ended, borrower diversification 20% cap to single AIFU seats borrower, and some prohibitions like lending to the AIFMD group or pure originate to distribute.
And liquidity tools.
Yes, liquidity management tools, LMTs, are harmonized. Open-ended AIFU CIs must pick at least 2 from a list: suspensions, gates, fees, swing pricing, etc. Need to notify CSSF on activation. ESMA is working the detailed technical standards for this.
What about delegation and substance?
Rules clarified, enhanced reporting on delegation, and a minimum substance rule. At least 2 full-time equivalent people, EU resident, running the IFM's business, plus an expanded list of ancillary services, enhanced reporting.
Has Luxembourg actually proposed the transposition law yet, as of early May 25?
Based on public info, no formal legislative proposal yet. The DORA law amended AIFMD UCI laws for digital resilience, but not the core AIFMD II stuff. Industry expects transposition by the deadline, maybe a minima approach, just implementing the EU minimums.
What's the likely impact in Lux?
Well, for loan origination, it's very relevant for the big debt fund sector here. Clearer rules could boost it, but the risk retention, diversification, leverage rules need careful handling.
LMTs will mean work for all open-ended funds.
Reviewing frameworks, updating documents, procedures for selection and activation.
Yes. And the 2-person minimum substance rule probably just reinforces current CSSF expectations anyway.
So watch this space for the actual Lux law in the ESMA details.
Definitely. It's about market maturation, investor protection, systemic risk. Luxembourg will adapt its leading ecosystem.
What about LTIF 2.0, the European Long-Term Investment Fund revamp?
Yes, LTIF 2.0 aims to make them more attractive, broader assets, easier retail access. Luxembourg's already a big LTIF player.
And Lux is supporting it proactively. The modernizing law from July 2023 actually exempts our AIFs Part 2 UCIs and SIFs authorized as LTIFs from the annual subscription tax. That's a nice incentive.
Could LTIFs be used for long-term group financing?
Potentially, yes. For long-term projects like infrastructure or real economy assets, if they fit the LTIF rules on eligible assets, diversification, and investor protection. The combo of flexible LTIF 2.0, retail potential, and the Lux tax break could really boost them here.
Again, conflicts in governance would be key for related party stuff.
Absolutely. And they're inherently long-term vehicles, so not for short-term group needs.
What other trends are influencing things? Sustainable finance, active ETFs.
Both are growing strongly in Luxembourg. Sustainable finance AUM keeps rising, helped by the reduced subscription tax for taxonomy-aligned investments in retail funds. You can see sustainable funds financing green loans or green bonds within groups if criteria are met.
And active ETFs.
They're gaining traction too. The subscription tax was removed for them in early 2025. CSSF clarified disclosure rules, simplified launching new share classes.
Could they invest in group debt?
If it's listed, fits the active strategy, and meets UCI SEIF rules, theoretically, yes. Like other UCITEs, their direct lending role is limited, but they're another evolving part of the market groups might interact with as issuers or investors.
You could even see sustainable active ETFs doing private debt eventually.
It's possible, especially with AIFMD II's loan origination rules. Shows how these trends might converge. But always, conflicts and arm's length are paramount for any related party financing by a fund.
Okay, and the elephant in the room. ATED 3, the Unshell Directive. Where does that stand?
Still under negotiation among member states as of early May 25. No final text, no firm timeline. The original proposal faced pushback, so the final version might change.
But the core idea is minimum substance requirements for EU entities.
Yes, common EU rules.
Yes.
With potential tax consequences if you fail denial of treaty directive benefits, maybe look through taxation. Targeted mainly at entities with mobile income, like interest or royalties, but limit as local substance.
So potential major implications for some Luxembourg holding companies, including SOPARFIs.
If adopted, similar to the proposal, yes. Own premises, active EU bank account, qualified local directors employees actually managing things. Those were the kinds of indicators proposed.
But regardless of ATAD 3's final form, the direction is clear. More substance needed.
Unmistakably. It's already there in TP principles, GAR, CSC rules. Luxembourg entities, especially SOPARFIs and cross-border financing or holding roles, must proactively review and enhance substance. Personnel, decision-making, physical presence, real business activity matching the income.
Better to act now than wait.
Much more prudent. This whole discussion is likely driving a flight to quality. Structures relying purely on tax trace with no real presence are becoming untenable. It could reshape SOPARFI use, putting a premium on operational reality.
Were there any other very recent specific updates right before May 9th? New laws, CSSF circulars?
Looking right around early May 2025, no revolutionary changes specific to SOPARFI fund financing dropped just then. Government meetings discussed other topics. The 2025 budget process was ongoing. Budget laws can contain tax changes, so that needs watching. Parliament had discussed tax reform, potentially being discussed further in May. Again, outcome pending.
No new major circulars from the ACD or CSSF right then?
Not specifically overhauling these rules. The key TP and interest limitation circulars remain in place. CSSF 18698 on IFM governance is still central. We're expecting more CSSF guidance on AIFMD II transposition details, though.
So continuous evolution, but no single big bang right at that moment.
Correct, but the broader context is key. AIFMD II is coming. DC8 on crypto reporting is another big transparency push. The cumulative effect of all these EU directives, ATADs, DEX, AIFMD II, DORA plus OECD stuff, it makes the operating environment much more complex and compliance heavy.
The cost of doing business goes up even if Lux remains attractive.
Exactly. It demands more sophisticated governance, robust controls, ongoing expert advice. The Luxembourg advantage is shifting. It's less about just structure and rates, more about expertise, a robust compliant framework, and hosting genuine economic activity.
Okay, let's try and synthesize all of this. What are the absolute key takeaways and strategic pointers for navigating Luxembourg Intra-Group financing now in May 2025?
Well, the big picture is Luxembourg remains a top-tier hub, flexible framework, potential efficiencies, great expertise. But the operating environment is way more complex now. EU OECD rules on anti-avoidance, transparency, substance have bitten hard.
Arm's length principle is non-negotiable. TP documentation is critical.
Absolutely. SOPARFIs offer flexibility but are hit directly by ATAD limits, GAR hybrids, and potential ATAD 3 looms demanding real substance.
Investment funds, especially AIFs like RAIFs, offer alternatives. AIFMD II gives a path for loan origination but brings compliance burdens, risk, conflicts, LMTs.
So constant vigilance, proactive adaptation are key. Strategically, substance is king. Ensure and document genuine economic activity, people, decisions, capital, operations in Luxembourg. That's vital for TP, ATAD, and future-proofing against things like ATAD 3.
Need an integrated compliance approach, tax, legal, regulatory together.
Can't be siloed. And robust governance and conflict management, especially if funds are involved with related parties. Follow CSSF 18698 AIFMD UCI's rules. Maybe get independent oversight.
Documentation.
You said it. Contemporaneous, comprehensive, tailored. TP studies, commercial rationale, DSE6 checks, fund disclosures, board minutes, everything.
Need to monitor AIFMD II transposition and the ESMA details closely.
And adapt fund structures and operations as needed. Also, anticipate ATAD 3. Assess your SOPARFIs now. Evaluate substance. Plan enhancements. Don't wait.
And finally,
leverage local expertise. You need good Luxembourg legal, tax, regulatory advisors to navigate this. The Luxembourg advantage today is built on substance, governance, compliance. Adapting to that reality is how you continue to find value here.
And that's your Luxembourg financing playbook, supercharged for May 2025. Go forth and structure wisely.
Hit that subscribe button for more in-depth analysis. You've been listening to the Luxembourg Fundcast.